Good afternoon, everyone. I'm Anthony Valeri, Director of Investment Management at Zions Wealth. Thank you for joining our 2026 Economic and Financial Market Outlook webinar. We'll spend about 25 minutes on prepared remarks and then move to Q&A. So let's go ahead and get started. And no discussion of the outlook would be worthy without a look at the policy impacts. They are numerous. They are very impactful as we head into 2026. So let's get right into it. First and foremost, fiscal stimulus is coming. It's on the way and it will be powerful. This is stimulus coming from the One Big Beautiful Bill Act, and it will be a significant percentage of GDP. So 9/10 of GDP is the dollar amount of stimulus coming to the economy. That is significant, and that is coming in the form of tax cuts for consumers. We'll likely get a slew of tax refunds early in 2026. There are business benefits as well, 100% bonus depreciation, immediately deducting the full cost of machinery, R&D expensing, and then a host of other deductions for businesses. So a lot of stimulus coming to hit the economy. That is a positive for equities. It's a positive for the economy. And again, this is very significant fiscal stimulus, and it'll remain positive in 2027 before turning flat and then negative out in 2029 and 2030. So fiscal stimulus in the US will be significant, but it's also happening globally. So when we look at fiscal policy in Germany and Japan, also stepping on the gas. In terms of Germany, this started in early 2025, sort of as a result of the US backing away from the Ukraine-Russia war involvement. Germany announcing almost $1 trillion in euro defense and an infrastructure package. They also removed what they call the debt brake on fiscal spending. That is a generational type move and worthy of note. There are doubts on whether that will have an impact in Europe, as often that stimulus has been questioned. But late in 2025, German factory orders exceeded expectations, and probably the first tangible sign that that significant dollar amount will have an impact moving forward. And then similarly in Japan, big stimulus announced there in November with a new government taking over. A little bit of a ripple in Japanese bond markets yesterday as the administration announced for a delay in tax increases that would be used to fund stimulus in 2026 and beyond. So again, big stimulus coming not just in the US, but globally as well. And that is going to be a positive for global growth and in turn, corporate earnings. We'll get to that later. If the fiscal policy front wasn't enough, we're having stimulus coming or easier policy from the Fed. The Fed is expected to cut rates again in 2026. This is the futures market showing the anticipated overnight rate, again, measured by futures. Futures are basically pricing in 2 more quarter basis point rate cuts for 2026. We think it's more likely that the Fed only does 1. But again, futures expecting 2 more rate cuts, which again will help with corporate profitability, will be an aid for economic growth. And you can see the trajectory where the futures market does expect the overnight rate to bottom at about 3% late in 2026 and basically remain there in 2027. I'll take a note here to talk about Fed independence. That is a common question that comes up. Fed Chair Powell, it will not stay past his end date in May of this year, but a new Fed chair is just 1 vote. Do remember there are 12 voters on the Fed's open market committee, and we've already had 2 dissents in favor of keeping rates unchanged in December. So it is just 1 vote. So while we do think the Fed independence is a concern, translating into a more serious risk, we don't think is likely. Now, moving over to other Fed policy, the Fed's buying bonds once again. In December, they ended QT, or quantitative tightening, for fears of disruption to the money markets and therefore the bond markets in turn. So the Fed basically is reinvesting maturing bonds into short-term treasuries. That is boosting liquidity and exerted downward pressure on short-term interest rates. So all of that stimulative and helping not just the economy, but financial markets in turn as well. So the Fed is easing, fiscal policy is positive, and tariff price pressures will be slowly easing. This is the effective tariff rate in the US, and we show a timeline here starting in early 2025, and you can see the various tariffs that were implemented over time and a steady ramp up to almost a 30% effective tariff rate in early April, which was quickly scaled back. And then as you move to the right, you see that the Supreme Court's expected to rule soon on the validity of IEEPA tariffs under the IEEPA. It's expected the Supreme Court's going to rule against it. However, the Trump administration does have a backup plan if those tariffs are ruled are not valid under that emergency measure. So they'll likely come back. If they stay off, that drops to an 8% tariff rate. Our expectation, again, with other tariff measures to maneuver around that the effective tariff rate goes back to around 12 to 14%. However, that is a lot lower than what was stated and implemented for much of 2025. And keep in mind that year over year, starting in June, actually, tariff pressures will go negative year over year. So while there's a one-time price increase, the impact of tariffs will gradually fade. I should mention also with the recent news on Greenland and tariffs on 8 European nations in response to that, that dollar amount is 37 billion. That's very manageable. Don't see that being too big of a stumbling block for financial markets. Of course, news today suggesting the Trump administration is backing down on the rhetoric. More to come on that. And as an example, from April 2 to April 9, what a change in terms of the rhetoric on tariffs, and then a sudden switch leading to one of the biggest single-day gains in the stock market on April 9. So do note that it's hard. You can't invest on those types of news headlines, and they can change quickly. All of that taken together has created favorable financial conditions in the markets. This is the Bloomberg Financial Conditions Index, which measures a host of financial market indicators from the bond market, yield spreads or credit spreads, volatility, and equity market conditions. The higher the line, the easier financial conditions are and more conducive to better returns from the equity market. Conversely, when it goes negative or falls, those tighter conditions prove to be a headwind for the equity market. So as of now, despite what were elevated rates, conditions remain easy, and with all that stimulus, likely to remain so. So the backdrop, relatively favorable from a policy standpoint, but what does the market say in terms of that voice? It's often, as investors, we like to look in our group, what is the message from the markets? What are various metrics saying about the health of the economy and financial markets? So we'll start with the yield curve, which is steepening. This is the yield differential between the 10 and 2-year Treasury. The rising line means the yield curve is steepening and therefore a growth signal. You'll note the Great Recessions are shaded in gray. We had a false signal in 2022, but since then, the yield curve has steepened and continues to steepen, which is a sign, again, from the bond market of growth. Moving to metrics within the equity market, here is consumer discretionary stocks versus consumer staples. When the line is rising, consumer discretionary is outperforming consumer staples and vice versa. You can see consumer discretionary outperforming since the tariff tantrum lows in early 2025. Again, a positive signal from the markets on the health of the economy and a positive for a pro-cyclical expansion for stocks. And it's not just consumer discretionary. Industrials have outperformed relative to the S&P 500 here in the last few months, as have materials. Again, both of those pro-cyclical and a vote of confidence from the market. And then finally, on credit markets, the yield spreads or credit spreads are very narrow on a historical basis. This is the average yield advantage of high yield bonds relative to comparable treasuries. Very low on a historical basis, actually just under 3%. Conversely, this makes high yield unattractive from an investment standpoint. So we don't have high yields in our fixed income allocation, but it does show you that fears over defaults are pretty minimal. If you were to see an early warning sign over credit conditions, you'd see it here in the high yield market, and we're not seeing it now. And yield spreads can remain narrow for some time, but the narrowness narrowness of credit spreads is certainly positive for financial markets. All right, let's move to the economy. And first and foremost, we'll look at economic growth. Here is the trajectory of economic growth, recent quarterly growth with total GDP in dark blue. And then if we strip out the AI impact, which would be software and information processing equipment, you'll see that growth would not have been as strong had you taken out the AI related component. The first quarter would have seen a 1.9% drop versus what was reported at 0.6% drop. But you'll see the last two quarters have seen very strong growth. The fourth quarter is yet to be reported. The expectation is 1%, but that is coming up. The Atlanta Fed GDP Now indicator is tracking to over 5%. And you're starting to see Bloomberg consensus move higher on those growth expectations as well. Yesterday, a Wall Street Journal report of economists increased their 2025 growth estimate to 2.3 versus what you see here at 2%. So the economy has some strong underlying momentum that we think will continue into 2026. Let's take a look at the consumer, which has been a workhorse in this economy and remains very resilient. On the left, retail sales, ex auto and gas, to get a true look of the consumer and strip out more volatile impacts. This is data through October and saw a healthy 4%, over a 4% growth rate on an annualized basis. Really no flinching here, steady consumer involvement. Recently, late last week, received data on November. That too was strong. And by all metrics, holiday spending was very strong. On the right, Johnson Redbook same-store sales tracking have increased over recent weeks and now tracking to a 7% annualized rate. Yes, much of the spending is coming from upper income brackets, but it does show that the consumer remains quite healthy and a driver of economic growth. Turning to the labor market, which is a soft spot within the economy, on the left, we show the change in monthly payrolls, and you can see the slow deceleration for much of 2025. For all of 2025, there were 584,000 jobs created. That's a lot less than just over 2 million created in 2024. The unemployment rate ticked higher to 4.4% from 4%, but that is a relatively modest slowdown that we do need to track, but it is still a low hire, low fire labor market. On the right, weekly jobless claims still and near historical lows. This is one of our favorite early warning signs on the economy. And again, when weekly jobless claims are this low, we do think that although hiring has slowed, we're not seeing the firing that would be more of a red flag on the economy. And then business investment, another key pillar of economic growth, very strong, much of this AI related. And then outside of AI, it is a little weaker, but again, showing business investment remains strong and a key driver to economic growth going forward. We'll talk more about AI when we look at equities. And then lastly, inflation has been stubborn, but is well off the peaks of 2022. The latest CPI showed a 2.7% annualized growth rate with 2.6% core. Both were a little better than expected. We do think inflation remains stubborn, and therefore the Fed will only cut once, we believe, this year. Inflation likely to settle out where it is now, between 2.5% and 3%, perhaps closer to 3%, which would limit the ability of the Fed to cut rates. But declining rents, lower energy prices have more than offset the impact from higher tariff costs. All right, let's move to the equity markets, and we'll go to the S&P 500, where another strong year of calendar year performance. The S&P was up 17.9%. As a third strong year of good performance. And on a 3-year trailing basis, the S&P 500 is up 86%. That's the 8th strongest 3-year trailing performance since 1950. Worth noting that on any given year, you can see from this chart, about 80% of the time, the stock market finishes higher. Specifically, out of 76 periods, 60 were up, 16 were down. So that 80% batting average is why you want to stay invested in stocks. However, a fourth positive year, the batting average drops and to about a 50%. So a coin flip whether the next year is positive. With that lower batting average, however, shouldn't discourage you from investing. Just expect lower returns given the strength of recent performance. And we expect more moderate returns. I'll get into that in a moment. But one of the themes in the market has been the breadth or the concentration that's driven performance. The percentage of stocks outperforming the S&P 500 still very low for the third year running. So a concentrated portfolio worked. Diversified investors have benefited, but not to the same degree from the concentration in the markets. We think that changes going forward, and it also presents a risk. It's important to notice that 161 stocks outperformed the S&P 500 last year. That's relatively low, and 179 actually had negative returns. So it was a challenging year under the hood outside of that concentration. So it's something to watch. And why we think that's important is we look at the concentration on the left, and that 40% concentration, in other words, the top 10 are 40% of the S&P 500. It's never been that concentrated. That is a record level of concentration. Back in the dot-com era, 2000, that concentration peaked at about 29%. So we haven't seen that concentration in a while. And what does that mean? On the right, we show the impact of a 10% drop in the top 10 stocks. And that impact over recent years has increased as they have gained in terms of market capability or market size. And therefore, we remain diversified, although that has been a drag on performance. We think that's prudent going forward. Investors probably think it's ancient history, but in 2022, the Mag 7, which includes that concentration, was down 50%. So it's a warning as to what could happen should those lofty expectations in the tech sector not materialize. Well, when we look at the equity market broadly, the valuation is expensive as measured by the PE ratio, which you can see in the green line. That's elevated around 22. And the profit margin, however, is supporting that. So while you think that, well, we know that equity markets are expensive, just looking at the PE ratio, it is supported by strong fundamentals in terms of a very high profit margin of around 18%. We don't think valuations get more expensive from here. So trying to anticipate the market getting more expensive is not realistic in our view. Those operating margins are about as wide as we think they will get. They might contract a little bit, but it's tough to get negative on stocks with such a strong profit margin in place. One sign where we think investors are starting to show some hesitation with regards to higher valuations in the tech sector. Interesting stat here. This is the price to earnings ratio on the technology sector in the S&P 500. And it did not change in 2025, which means that investors, despite all the good news from technology, were unwilling to place a more expensive valuation on technology. That means all the return came from earnings, which is good, but it does show a limit to the amount investors will pay for certain equities. So something to watch going forward. Again, we do think valuations remain elevated, and why we think we expect lower returns. Here's another driver that we think has impacted equity performance. The bond market has certainly taken note of the AI debt surge. On the left, we show the credit default swap for Oracle relative to the investment grade corporate average. You can see it's broadened out. That was in response to Oracle, OpenAI rather, paying Oracle $60 billion a year for cloud computing services they haven't built yet. They don't have the cash flow to fund that, so they went to the debt markets, and the bond market took note. And then on the right, we show the average credit default swap for Apple, Microsoft, Google, Broadcom, and AMD. And while they did increase in 2025, they still remain low relative to history. So this is not to be alarming. Paying a 35 basis point fee to insure debt via credit default swaps is still very low relative to history and low relative to 2022. But it is a sign that the bond market and investors have taken note of this AI cycle and increased debt. All right, earnings are expected to broaden. This is the key factor why you want to remain in equities, and it's tough to get negative on equities when earnings have been this strong. So 4 consecutive quarters of double-digit earnings growth. The fourth quarter is expected to be around 9. We would not be surprised to see a fifth quarter of double-digit earnings growth. And then for all of 2026, the expectation is 16% growth. That is very strong, well above the historical average around 7, and our expectation of an average of 8% earnings growth over the next 5 years. So earnings, a key driver of equities and why you should remain invested going forward, even if those earnings don't match that 16%. That's still even a low double digits, high single digits would be supportive for equity prices. So the outlook for earnings is strong. Valuations, less so for the large cap U.S. stocks. We show the S&P 500 on the dark blue line, again, supported by wide profit margins. But you'll see the gap to basically every other component of the equity market. U.S. small caps, developed international, emerging market equities have much more favorable valuations. And since the beginning of November, we've seen a rotation in the market away from the concentration of the S&P 500 into these other sectors. We do think that continues. It's important to be diversified. And within international, we do find emerging markets more attractive relative to developed international. But in the long term, more attractive valuations are what are going to drive stronger returns. So important to maintain access to these sectors and not look in the rearview mirror on S&P 500 returns. Speaking of international, it was a strong year last year for international. A lot of that fueled by a tailwind of a declining dollar. The blue line is the trade-weighted dollar. You can see the decline. You can also see that it's still elevated relative to history. And that fueled, you see the tight correlation between the performance of international versus U.S. stocks. And that tracks closely. And from 2001 through 2008, you'll see that a weaker dollar generally favored international. And since then, it's been an extended run of outperformance of U.S. versus international. We maintain a slight overweight to U.S. relative to international compared to our benchmarks, but there is more scope for a weaker dollar to provide a tailwind here for international. So maintain exposure there. We do like EM more there. Another trend in the equity markets, which we think will continue to reverse, is that of quality. Lower quality stocks, specifically companies without earnings, without profits, outperformed for much of 2025 before that reversed later in 2025. We think that continues about 75% of the time. Higher quality stocks are going to outperform low quality. And you'll see that here on this chart. It's rare to have that kind of a turn of lower quality stocks outperforming. A number of investment products that focus on higher quality stocks underperformed. As a result of that, we think that reverses. Those non-earners we don't think are a good way to invest. So some of the passive products that include those we think are set to lag. We focus on higher quality stocks going forward. And we think, again, that changes going forward. So rare to see that type of outperformance from non-earners. And then lastly, a couple charts on the midterm elections. Midterm election years are often volatile and choppy. This is the average path of the S&P 500 in a midterm election year. And you can see, again, the ups and downs. And then starting in October and early November, the market has been very strong. So again, if midterm election years are any guidance, this is from 1946 to 2022. It'll be a choppy year with lower returns, the average return of just under 5% for the full year. And also note that the average decline in a midterm election year is almost 18% versus 14% in any other year. So midterm elections years can be volatile. Interesting side note, from November 1st of the midterm election year to this following November has been positive every time since 1946. So a separate something else to look forward to later in the year. And then finally, from a policy perspective, the midterm elections are likely going to end up in a divided Congress. We showed the change in House seats on the left and change in Senate seats on the right from the incumbent's party following a midterm election. And a pretty consistent trend that the incumbent party in power will lose seats. Right now, the probability markets, poly market, is showing an 80% probability that Democrats take the House and only a 30% chance in the Senate due to the fewer seats changing over there. But we're likely to see a divided Congress, which means additional policy measures likely to be limited. Okay, let's wrap up with our outlook for fixed income. And in the equity markets, while our final number is about a 6 to 8% return we expect over the next 5 years. So certainly a moderation from what we have seen. When we go to the bond market, we think yield is the best predictor of future returns. So if we look at the current yield and then look at trailing 10-year performance, that is a good predictor of what to expect. The 4.3% is the yield on the Bloomberg Aggregate Bond Index. So that is where those returns will track to. It's been a brutal period for bond investors after the worst bear market on record. Bonds bounced back last year with the aggregate up over 7%. We think that moderates. It's more of a mid-single digit return for high quality bonds. But that is where the focus should be within the bond market, to be a diversifier for equities And within bonds, we find value in municipal bonds, still finding value there. This is the green line is the taxable equivalent yield on the municipal index, assuming a top tax bracket. You can see that green line tracks very closely to the corporate index and is not far different or not very different from the taxable aggregate overall. You'll see the gap that emerged in 2025 on the right, that was due to a supply surge, and municipal bonds were inordinately punished in our view as the market couldn't handle that surge in supply. That gap has slowly started to close as municipal bonds improved, and we expect more of that over the course of 2026. So still finding munis attractive. And then emerging market debt, in an area we exited late last year, we find this, like high yield bonds, expensive. And here's the average yield spread to treasuries, now under 2%. You're just not getting compensated for the risk. And we prefer to have high quality bonds in the portfolio. All right, that concludes my remarks. I'll turn it over to Rebecca for some Q&A.
All right, thank you so much, Anthony, and so much good information. I know we are coming to close to the end, but there are really two questions that I think maybe we could expand upon a little more. One is really around interest rates. You talked about some dissent on cuts and domestic inflation. So when we think about interest rates and inflation in the broader market context, anything to comment on there?
Yeah, I think inflation stays relatively close to 3%, and then range bound on the bond market. So we'll see a 10-year in our view between 4 to 4.5. And I know there's this concern about risks in the market. If the 10-year Treasury yield rises closer to 5, that historically has been a bit of a hiccup for equity markets and presents a risk. So something to watch, but we don't see that being sustained, given that we don't see inflation coming back up and we don't see the Fed hiking rates either.
Perfect. And then last year, we sort of saw the return of some of our international markets performing. And one of this question is really specific around the European markets. Do we think the European markets outperform again? And I think maybe just a comment on why we stay diversified, because it'd been quite a while until we hadn't seen that performance in a long time. Questions about why you keep these exposures. And then let's talk a little bit about what happened last year.
I think the weaker dollar was a tailwind. I think investors finally took note of the fact that international valuations were significantly cheaper, and they still are. As we head into 2026, yes, maintain an exposure. For any US-based investor, we do think you want to be obviously focused on the US, not take that currency exposure. For Europe, which is about 50% of international markets, the earnings outlook is certainly more compromised or reduced this year. So we think Europe is roughly in line with US markets, where we find better values in mid caps in the US, and certainly think the earnings story in emerging market makes it more compelling. So we're looking at that area a little more closely within international markets.
And then one question as we wrap up. We've had a volatile couple days, pretty big pullback yesterday, nice kind of return today. And you also mentioned how in midterm election years, we see more volatility. How do we talk to our clients about making decisions in really long-term? Investing is a long-term strategy, not a short-term. But obviously, when we see those drops, it can often bring back feelings from markets past. So how are we thinking about some of that volatility?
I would think, you mentioned it, Rebecca, you have to have a planning long-term approach. All of this sort of day-to-day noise washes out in the end. It's also a good reminder when you have uncertainty mentioned in the media, don't know what's going to happen on a policy front. Those end up being good times to buy, actually. So it may not feel good that day, but in the long term, that ends up being a good time to buy. Stay focused on the longer term, because those do present opportunities.
That's great. Well, thank you so much, Anthony. Appreciate it. And thank you, everyone, for joining. As always, we're here to help answer your personal questions, and we appreciate your participation.
Thank you.